my screen and presentation title right
Yes.
now? Okay,
Yes.
perfect. It's perfect. Now let me start the presentation. Here, as you see, the title is Europe Outlook and Report 2025. And here, let's start our session with the global inflationary pressures and what's happening. Because after the COVID-19 crisis, what is happening in economic policy in the world? It is independent from where you are, even in Europe, even in America, or even in Asia Pacific. If you are living the economic problem after the COVID-19 crisis, the basic answer behind those questions and the problems is inflation. Actually, the price pressure dynamics. There is a upside price pressure dynamics in the world inflation dynamics throughout the world. And there is a head one. There are lots of additional problems those basic inflation are. What type of problems? First of all, the supply chain side. Because normally inflation is demand pull inflation. But if it is supply push inflation, it is very problematic. Okay. So normally if I increase my demand, the price is going up. But if the cost of the producing something or delivering something is increasing, and if the problem is coming from not the demand side, but the cost, which is supply side shock, it is long-term inflation rather than just decreasing the demand. So how can I explain in other words? If the inflation is demand side inflation, you can deal with those type of demand inflation by just changing the interest rate, by just changing the credit condition in the economy, and you can down or upside those demand side inflation. Okay, it is easy, and you know what type of tools you should use to fight with the demand side inflation. But if the inflation is supply side, cost side, production side, delivery side, it is problematic. For instance, after the COVID-19 crisis, when all the economies and the market is closed, Baltic Dry Index, which is a well-known measured index throughout the world and showing the cost of delivery of the products from Singapore to China, from Shanghai to China, from California to China, or from Nordic states, Scandinavian to Australia. This is showing as called Baltic Dry Index, showing the cost of delivery of the product. In the good times, it is really lower, and it is easy to access your products if you put an order from China, and if you are using, let's say, Amazon, your products at most will be at your home in 20 days. But in the COVID times, this time is increasing approximately 2 months from 20 days, and the bringing cost of that product from China to United States is increasing to $60 from $20. So this type of supply side shock is not easy. For instance, you cannot find a solution to bring those products from China to United States easily. Okay, it cannot be solved in 1-2 days, or it cannot be solved in 1 month. This type of problem is supply side shock. So if we are focusing on what's happening in global inflationary pressure in core inflation side, by the way, we can have two types of inflation generally in the newspaper, in the internet, or whatever you read and see. These are the headline inflation and core inflation. Headline inflation is the top number you see on the news and the screen. And the core inflation is calculating from the headline inflation by excluding some type of goods and energy products, some items of goods and energy products from headline inflation. For instance, in Turkey, in my country, if we are calculating the core inflation, we are excluding from the headline inflation the energy, the oil prices, and the alcoholic and tobacco beverages. Okay. So if we are excluding those items from the top headline inflation, we will see the core inflation numbers. And here, as you see on the left-hand side, in this graph, we have the core inflation for three countries or three regions. The black one is the United States. By the way, the x-axis here showing the time frame from 2000 until now, approximately 25 years. And here on the y-axis, you will see the percentage change of the number. This is the core inflation, year-over-year change. And the black line showing the core inflation in the United States, the purple one, the Eurozone, and the light blue is the United Kingdom. As you see here, please take a look at here. What happened here? Why the UK inflation is suddenly gone up? Because there are lots of measures and the stimulus which is introduced from the United Kingdom government after the global financial crisis in 2008, right? We have a big, I'm sure lots of people remember here, but if you are interested in economics, you will never forget three dates in the history. One is the Great Depression in 1929, and one is the global financial crisis in 2008, and one is 2019, the COVID-19 crisis. So as you see here, the inflation is going up in lots of countries because there are a big stimulus in the central bank measures after the global financial crisis. But here, there is something is unprecedented, right? It never happened again. Actually, it has never happened during 25 years in the history that the core inflation is reaching approximately 7% in these three biggest developed market economies. Yes, you can see 7% or 10% inflation in Ukraine, South Africa, Brazil, Indonesia, Malaysia, Turkey, Russia, or lots of emerging market economies, right? Because these countries are emerging markets, developing or less developed countries. But what is making the inflation is stationary in the developed market? It is around 2%, right? Please take a look at the number here. During approximately 20 years, the inflation is around just 2 or 1%. Only 2 or 1%. Stationary, it is not volatile, it is not going up, and it is really low. Because in developed market economies, lots of market outlook is less volatile and has a stationary outlook. But there is a crisis shock here in 2019. And it is bringing the core inflation approximately 7%. What is happening here? What I say, Baltic Dry Index is rising up. Nobody bring any type of items, goods or services from the rest of the world. Because in the United States, you need lots of goods and products from Asia, China, Russia, or the Middle East. But you cannot any opportunities, you don't have any type of opportunities to bring down those type of products and items because every market is closed down. So if you cannot bring or if you cannot increase the supply of the products, the price is going up, right? Because there is less product in your country right now, and its prices will go up. The core inflation is going up here. And right now, with the central bank measures, quantitative easing, quantitative tapering, there are lots of measures that the United States, Eurozone, and United Kingdom take those measures to fight with the inflation throughout the world. And right now, the inflation is around 3% for those countries, but the prices are sticky around them. So we will see what will happen. And here, please take a look at here. We are here in 2025, and this is market-based inflation expectation. What we mean by market-based inflation expectation. Normally, we have lots of survey and expectation calculation. How can I define it? Let me find a basic definition for this. Normally, while calculating the inflation outlook, there are lots of agents making the survey and the expectation for the inflation or for any type of, let's say, the purchasing manager index, let's say the industrial production, any type of production and expectation have a surveys base. And you can see the numbers and the expectation from those survey numbers. For that reason, as you see here, this is the market-based inflation expectation. There is a survey, and this is five-year inflation swap. And this is showing that what is the inflation swap? How can you compensate inflation outlook during 5 years? This is around approximately 2.5% for the United States and the Eurozone, but in the United Kingdom, it is around 3.5%. Now, what brings those inflation outlook in the Europe and the United States? This brings the global monetary policy. The global monetary policy here showing what is the market expectation for central bank policy rate. Central bank policy rate is the main monetary policy tool that the central bank is funding the market. Let's say you are an investment bank, or let's say you are a deposit bank. You need some cash or you need some liquidity to manage your operation in the market. You have lots of treasury bills, government bonds, I mean collateral. Okay. And if you bring those collateral to the central bank, you can use lots of liquidity from the central bank. But with what cost? What should be your cost if you are using the money from the central bank? It is the policy rate. Okay. This is central bank policy rate that you are using the funding from the central bank deposit. And here, as you see, normally we were here. And what will happen for the next 3 years? Okay, these are the years. And where will be the central bank policy rate? What is the dramatic outcome from this picture? As you see here, central bank policy rate is really, really high for these three regions: United States, Eurozone, and the United Kingdom until the next year. But after the next year, we will be around 2% for this Eurozone, United States, and United Kingdom. But the dramatic outlook is the Japan. Every developed market economies decreasing their central bank interest rate, but the Japan, on the contrary, rising up the funding rate of the central bank. As you see, it is around 0, even minus, but it will converge to the 1% next couple of 3 years. It is really, really dramatic. Why? Because in Japan, we are seeing the problem of the inflationary output right now. It is the current problem of the Japan. On the contrary to the rest of the world, it is a sudden increase of the Japanese inflation, and to fight with those inflation environment, Japan Central Bank increased their interest rate. So we are seeing those numbers. It is the problem here. Actually, another problem here, as you see on the right-hand side, the global central bank balance sheet. You see that from 2008 global financial crisis, the central bank's overall inflation here, global central bank, this is the cumulative of United States, Eurozone, UK, and Japan. Okay, it was around in the global financial crisis, after the global financial crisis. Please take a look at here. There is a just small increase when you look at the pictures from here, it is small. But at that time, it was a huge money and liquidity in the market. It was around 4 trillion and reached around $7 trillion. Approximately $3 trillion increase in the market liquidity from the central bank balance. But after the global financial crisis, there is another problem, the COVID-19 crisis. And until the COVID, the total number of the central bank balance sheet around the world is just $15 trillion. But in 2 years, it reached approximately 25 or 27. Just in 2 years, $12 trillion expansion in the central bank balance sheet. This is a huge money, ladies and gentlemen. $12 trillion in central bank balance sheet is a huge money. I mean, just German gross domestic product is $3 or $4 trillion. You can think like this. This is a huge, huge money. Okay, $12 trillion in central bank balance sheet to trigger the economy and to create this inflation. While those central bank balance sheet increasing, this inflation is pushing up. Okay. Please take a look at this picture. Here, what you see on the left-hand side, this is the not monetary policy, but the fiscal policy of the governments throughout the world to fight with the inflationary outlook, to fight with the shocks in the economy, and to deal with the problems, especially after the COVID-19 crisis and global financial crisis. So, as you see here on the left-hand side, we have public sector investment. This is percentage year-over-year change, 3-year moving average. From which countries? Again, the black one is the United States, the purple one is the Eurozone, and the light blue is the United Kingdom. And this is showing, please keep in mind, public sector investment. The country is making public sector, and the government using the money to build up the underway, crossroads, highway, any type of things for your country. Okay, you can think like this. This is the fiscal policy side and public sector investment. As you see here in the global financial crisis, it is crashing. But after the COVID-19 crisis, the countries well understood that the interest rate or the monetary policy alone is not a sufficient mechanism to deal with the inflation or to deal with the macroeconomic outlook. What we need, there should be a coordination between monetary and fiscal policy to fight with the problems in the economy. So you can keep this sentence in your mind. Yes, we will see lots of times on the newspaper, on the television, on the YouTube or any type of platform that interest rate, increase in stock exchange, monetary policy. But the monetary policy is not a sufficient tool to deal with the problems in the economic output. What the problems they are? Budget deficit, inflation, balance of payment, industrial production, any type of macro indicators you can think. And the monetary policy is not a sufficient tool to deal with those type of problems as a whole. What we need, rather than just monetary policy, what we need the coordination of monetary and fiscal policy in the economy. Let's think this. If the monetary policy increase the interest rate, for what? To decrease the inflation, right? If I increase the interest rate, nobody buys something, nobody use the credit, and demand will go down and inflation will go down. This is the basic dynamics and the cycle of the inflation and interest rate. Let's say central bank increase the interest rate to decrease the inflation. But let's say again now, the government every day making
additional and additional infrastructure projects every day. Where should this government find the money? Either they will borrow from the international market or they will borrow from the domestic market, right? If the domestic saving goes to the government, what will happen to the private saving or private investment? Nothing, right? They will go down. If government increase the demand and trigger the economic output in the domestic economy, what will happen? The decrease in the inflation because of the monetary policy, but there will be an increase in the inflation because of the public policy, fiscal policy, right? Inflation will go up because government buy everything and everything from the market and increase the demand. So to find and to catch up the coordination between the fiscal policy and monetary policy, we should need the really good collaboration between the government officials and central bank officials, and there should be really good coordination between monetary and fiscal policy. And here on the right hand side, you will see the budget deficit. Budget deficit means overall budget deficit dividing by the GDP, meaning what is the percentage of the budget deficit when we take a look at the percentage numbers of those things. Please take a look at, again, the United States, Eurozone, and the United Kingdom on the graph. What you should take into consideration in this picture, if you take a look at the budget deficit side of the economy. As you see here, during the global financial crisis, budget deficit is reaching approximately 10%. And here it is approximately 20%. What is the problem here? Please make a brainstorm for just 15 seconds. What is the problem here? The problem here is coming from the triggering demand, not just with monetary policy, but also with the fiscal policy during the global financial crisis and COVID-19 crisis. Because government also bring the money, even just think the United States, the government sent the check, $1,000 check for the less income families, households, to bring their demand to higher before COVID-19 crisis outlook. For that reason, if the government sending those money or consuming, spending this money, where this money coming from? This money is coming from the budget, right? Budget of the government. And budget deficit reaching approximately 20% in the Eurozone, United States, and United Kingdom. And the government debt right now. As you see here on the left-hand side, the government debt, which is the cumulative of the budget deficit and any type of numbers from there, the government overall public or private debt. But this is the whole debt of the government from the economies. So what you see from this picture, on the left-hand side, as you see, from the global financial crisis, there's a huge increase. And here what we have, again, a rise sharp up from the COVID-19 crisis until the dealing with the 2025. And what the picture is saying, government debt will be around 130% of the United States GDP. It is increasing. For the Eurozone, it will decrease. It will be around 90%. And for the United Kingdom, it will be around 110%, and it is increasing again. And government debt, today a huge problem for the United States, approximately $40 trillion total debt of the economy. And it is really a big problem for Trump administration or any type of challenges that is coming from the public expenditure. Government interest payment here, as you see, this is the percentage of the nominal GDP. And because of this debt, you are paying the interest. And here, as you see, the United States will pay the highest debt with 4.5%. And the Eurozone is the less, it is 1.5%. And the United Kingdom will be around 3% for the next couple of years for their public debt interest expense. And global consumer balance sheet. Please take a look at here. Here the United States and the countries in the European Union. As you see, UK, Sweden, Spain, France, Italy, Germany, these are the European Union developed market economies, excluding the United Kingdom. And here we have an index, house price index. The index is fixed to 100 at 2015. And now, what is the index level? In the United States, it's approximately 190, meaning that it is twice time higher in the United States in 10 years. What is the lowest? It is Italy. It is just 10% increase in the house price in Italy. It is really lower. But average European Union economies is around 140 and 50, meaning that if you buy a house in the European Union, excluding the United States, with let's say the cost is $1 million, in 10 years, the price of the house will be around $1.5 million in the European Union. But if that house is in Italy, it will be just around $1.2 million. It is just around $1.2 or $1.1 million. The lowest house price inflation in the European Union is the Italian one. The household debt, and here, as you see, debt is decreasing until the global financial crisis. Debt is increasing. US, United Kingdom, France, and Spain, European Union economies, and the United States, until the global financial crisis in 2008. As you see, there's a huge and sharp increase in the household debt in the European Union. Then it has started decreasing. And what is the problem there? The problem is the governments and the central banks, from the Minister of Finance and from the Minister of Monetary Policy, they are bringing lots of solutions to deal with and to fight with the inflationary outlook in the household debt, and they should find some solution to bring down those overall household debt, because it is unmanageable if you let the household debt increasing in this higher interest rate environment. Because let's say the GDP percentage of the household debt reach 100%, and let's say to fight with the inflation, if we increase the interest rate to the 5%, how this household pay the debt with the cost of 5%? It is really high for them, right? They bring the money and they borrow the money with 1%, but they are paying back it's approximately 5%. It is unmanageable. And here, this is US, but let's go to the US Federal Reserve policy, meaning that how this, because here the US inflation, but this is Eurozone inflation. Why we are looking at the US Federal Reserve policy or US economic monitor, why we are speaking the European economic outlook? Because they were interconnected. Actually, until 2025, they were really, really interconnected. But from now on, nobody knows in the world except Trump what will happen next year, because he is really putting lots of unprecedented measures in the market. These are never seen in the market and monetary economics. Tariffs, lots of trade wars, lots of taxes, lots of barriers between the Europe and the United States. So here, while we are speaking about the Eurozone economic monitor, let's speak about what's happening in the financial condition. Here, as you see, Bloomberg financial condition, and please take a look at here. The light blue dot is showing 6 months earlier, and the purple one is showing, the rectangle purple one is showing the latest one. So Bloomberg financial condition is here at 70, and 6 months ago it was around just 40. So financial condition is improving in the European Union. Okay. And the consumer finance is not changing. It is really, really low when we make a ranking between 0 and 100. It is just around 20. Consumer confidence is really low in the European Union. And services PMI, what we mean by PMI? PMI is Purchasing Manager Index. This is the real market orders and the production of the factories or ordering from the market. And it is latest around 20, and 6 months early it was around 40. Meaning that today, business expectation in Purchasing Manager Index getting worse. It is losing momentum in the European Union. But for the manufacturing PMI, not the services PMI, but the manufacturing PMI, new orders is around the same level with the 6 months before, and it is really, really low. The worst scenario for the European Union is the PMI side, because financial condition can be solved by just changing the credit and the interest rate condition in the market. But manufacturing, Purchasing Manager Index, the orders from the rest of the world for the European Union products, for their cars, durable goods, anything, it was really low and just around 10. And the labor market, 6 months before around 55, and today it's around 40. Unemployment is also getting worse because there is no production at the willingness level. Okay, the production level, the ordering level is really, really low in the European Union when we compare to the 6 months ago. But if we focus on the employment market condition with the United States, please take a look at the United States employment condition. It is really, really good, tight and really good. Non-farm payroll, as you see here. Perfect labor market condition in the United States, but in European Union, it is really low. What is the problem here? For that reason, United States waiting and really, really patient to decrease the interest rate and have a chance to wait until the end of the year without changing the interest rate. But European Union, European Central Bank, in every monetary policy meeting, cutting the interest rate. Why? Because there is huge unemployment. And we need something to trigger the economy. We need something to buy from the market, to open new factories, to bring lots of orders from the market. We should decrease the cost of finance to bring down those outlook and to increase the stimulus in the economy. There's one for the 2025, the Eurozone headline inflation. What is the source of the inflation? And this is headline. Please take a look at, and please keep in mind, this is not core inflation. This is overall inflation. And here, as you see in the picture, please take a look at this one. Core goods here at this level, but overall inflation here. What is the negative contribution, energy. After the Russian-Ukraine crisis and Middle East crisis, the energy prices, Brent oil, petrol, reached approximately 140 per barrel, and there was huge energy contribution. Please look at here. What is the highest contribution to the inflation in 2022? It was energy, right? Approximately 6%, 5% inflation is coming from the energy. Why? Because the oil prices is going up as a result of the Russian, Ukraine, and Middle East crisis. But right now, as the crisis is solved, energy contribution is negative. Okay, energy is bringing down the inflation. But what is the problem? Services. Ladies and gentlemen, today, all the central bank is dealing and fighting with the services inflation. Demand side, goods inflation is almost solved. But the services inflation still stubborn, and around 3%, as you see here we are. Please take a look at the line. The line is reaching approximately 11%, and right now it is 3%. And 3% of inflation coming from 2% from the services side. We have 3% inflation, and 2 of them is coming from the services side. Please keep this inflationary outlook in mind, and for that reason, the main problem for the central banks to fight with the services inflation today. And here, as you see, Eurozone headline and core inflation. We have approximately, again, 15 years. Core inflation is black one, and the headline inflation is here. As you see, headline inflation is more volatile, right? Core inflation is stationary out there. Headline inflation is going up approximately 11%, and right now it is 2.5%. It is decreasing, but the core inflation is around 3.5%. It is higher because core inflation is less volatile and coming with a lag effect. It is slower but deep. Okay, slower but sticky, slower but stubborn. Okay, but headline inflation is going to the 11% and going down easily with a higher velocity. And here we have the European Union ECB central bank policy rate. What we mean by European Union central bank policy rate? This is the basic funding cost of the European Union central bank of the ECB. And as you see here, the funding cost is going down as of 2022. And from 4%, right now it is around 1.75%. But the market projection is saying that because of some inflationary pressure, it will rise above the 2% again. Okay, inflation will come again after 26, and the European Central Bank increased their interest rate again after the 2025. And here you will see on the right-hand side the spread between the German government bonds and Italy, Spain, and France. Ladies and gentlemen, you can see this. Germany is the riskless asset, and these countries' bonds and bills showing how much you are risky. If your spread is rising up between European Union, German, and Italy spread, there is a risk in the market. Please take a look at here. Italy and Spain government spread is reaching 5% here from the German market, and it is showing the risk. What is the risk here? Risk is global financial crisis and European Union euro crisis coming from the Greece, Portugal, and Spain. And here the problem is COVID-19. 5%, 3% deviation from the Italy government spread from German, and the France is really lower. It's stable and stationary outlook, but Spain again above 1%. And the last picture and last slide from my side today presentation is Eurozone economic surprise and the recovery of the European Union. And surprise is showing there will be some crashing as you see here, there is the crash in the European Union, but the recovery is coming until the end of 2024. But the United States is going down with the surprise index, and lots of market economic indicators believing that market will recover for the European Union for the next couple of years because they are the production economy. They have well and robust based macroeconomic indicators, but United States sides will be go down with a revising economic update because today the employment market, GDP growth, inflation is absolutely better than in the United States when we compare with European Union.